Several factors determine where you fall within the American economic system. According to a recent Pew Research Center analysis of government data, more than half of Americans fall within the middle class, approximately 160 million Americans. Despite the apparent comfort of middle-class individuals, many are trapped in debt and drowning in it. Hello and welcome back to the Finance Guardian channel. If you want to break out of the middle class, retire comfortably, and be different with your money, you should avoid these 5 middle-class money traps. So hit that subscribe button and the bell beside it and let's get started. Money trap number 1, taking on too much student debt. It is common for middle-class families to accumulate large amounts of student loan debt. It is the traditional path for middle-class individuals to complete higher education in order to obtain a career that allows them to earn a comfortable living for the rest of their lives. You probably already know that higher education is paramount to getting out of poverty and living a better life, if you are from an immigrant family or a first-generation person. However, there is a problem with this since college costs are constantly increasing. According to educationdata.org, the average cost of college in the United States is $35,551 per student. This number has tripled in the last 20 years with an annual growth rate of 6.8%. Student loan debt in the United States amounts to $1.75 trillion and is growing 6 times faster than the nation's economy. In addition, approximately 43.2 million borrowers are in debt for an average of $39,351. This means that most people start their careers in the red before they even begin earning an income. What can be done about this? Choosing a degree with a proven return on investment or ROI is important after you graduate. Even when you attend college just for fun, you should ensure that your underwater basket weaving degree will also result in a job that will provide you with a proper ROI. And if you plan on attending college to network and make meaningful connections that will advance your career in the future, still be sure to select a field with a high ROI. Science, technology, engineering, and mathematics (STEM) degrees are, on average, the highest paying degrees in the country. It is not wrong to incur debt to better yourself with a degree, but be sure there is a return on investment, as can be seen from a graph representing median weekly earnings by educational attainment. There is a strong correlation between higher education and higher weekly earnings. Money trap number 2, taking out a huge car loan. Once you've landed your first big boy or big girl job, earning probably the highest amount of money you've ever earned, you begin to be tempted by toys, which usually take the form of a new car. The reason you want to reward yourself is that you are proud of what you have accomplished. You have gone through a lot of interviews and finally secured the job that you have been searching for. Honestly, we really can't blame these people for this. This happens time and time again, but they need to recognize that they're making a huge financial mistake. So why is that? Because we just learned that most graduates carry tens of thousands of dollars in student debt to begin with. Why would you want to take on more debt in the future? Well, as a professional, you face a variety of pressures, particularly in corporate America, where peer pressure is high. In sales or client-facing positions, you want to maintain a certain image, so you will not drive a Honda Civic with 300,000 miles on it. And no, bumper stickers don't add extra horsepower, so you lease a BMW 3 Series or Mercedes C-Class to make a good impression. However, this new lease is now eating up hundreds of dollars a month that you could be using to pay off your college debt or student loans. In addition to limiting your income, you're hunting your soldiers, killing your soldiers, aka dollars that could be used for investing, which is how you begin to build wealth over time. LendingTree reports that the average monthly payments for new cars in the US is $563. The average for used cars is $397, and the average for leased cars is $450. In total, Americans owe nearly $1.4 trillion in auto loan debt. In addition, Americans typically borrow $34,635 for new cars and $21,438 for used cars. A new car loan lasts an average of 70 months. A used car borrows for 65 months and a leased vehicle for 37 months. If you are paying $563 a month for 70 months, you could have used that time to build wealth or pay off debt. Avoid getting a large car loan if you want to build a strong financial foundation. Money trap number 3, not taking into account the soaring costs of healthcare. Many families struggle with healthcare costs, and it has had a large impact on their finances. Compared with 3 years ago when a family's maximum out-of-pocket healthcare expenses were $8,800 a year, today they would have to spend $21,500, an increase of 144%. The Pew Charity Trust reports also found that income has remained flat while healthcare costs have increased. This puts an even greater strain on your budget. Financial plans must prioritize emergency fund savings due to the increase in healthcare. As a general recommendation, young adults are advised to save $1,000 in emergency funds. The next milestone has 3 to 6 months of expenses. A job loss, unforeseen home repairs, vehicle problems, and the like are all emergencies, the most prevalent being the loss of employment. Having said that, it is interesting how popular culture has changed how people perceive healthcare financially. We do not usually refer to healthcare expenses as healthcare expenses. Instead, we refer to medical emergencies. They are not all medical emergencies. Some expenses may be necessary. Instead of avoiding annual checkups, vaccinations, blood tests, and the like are later experiencing a medical emergency due to neglecting preventative care. It is prudent to account for them. Another healthcare concern is that when someone loses their job, their employer usually offers COBRA coverage for up to 18 months following the loss of their job. In most companies, however, the COBRA cost exceeds the amount deducted from their paychecks. Therefore, it is necessary to save enough to cover their expense and the out-of-pocket limit for the remainder of the year. Money trap number 4. Not carefully evaluating the cost of housing. Besides healthcare costs, many middle-class families struggle to make ends meet with rising housing costs. Some people wonder whether switching from renting to home ownership is a better option, but this is not the case for everyone. Too many people purchase homes with insufficient equity, which is the difference between the market value of the house and the amount owed on the mortgage. You can easily fall into financial trouble if you purchase a house with a minimum down payment and a 30-year mortgage. When your home is only valued at 3% and declines by 6%, you suddenly find that you're paying more than the house is worth. The other extreme is no better. Some individuals save for a long time and put down 20% on a home. However, in the process, they do not save for retirement or provide for an emergency fund, which can result in further financial hardship. It is a wonderful goal to own your own home, but attempting to do so without financial readiness causes unnecessary stress. To avoid this risk, wait until you have saved sufficient funds for a down payment before you purchase a home. The ideal down payment is 20%. However, if the house is a fixer-upper and necessary renovations will increase the property's value by 20% within 2 years, I would also be comfortable paying 10% to avoid paying mortgage insurance for an extended period of time. But at the same time, do not neglect your other long-term savings objectives such as retirement. Money trap number 5. No trust in the stock market. The final money trap among middle-class individuals is not investing enough in the stock market or not investing at all. Most middle-class Americans do not trust the stock market and do not own any investments. That is unfortunate since investing in the stock market is one of the best ways to make money in the long run. People believe that the stock market is too complex, difficult to understand, unpredictable, and volatile, so they lose money when investing in it. When they decide to invest, many Americans think that investing in CDs, bonds, or other low-return investments will enable them to survive retirement. But the fact is that most of these options